From one retail investor to another. This is Trader72. Welcome back, guys, for my second upload this week. I hope you enjoyed the last one. It is still an absolute scorcher here in the UK. It is sweltering hot, and it certainly looks like it's extended by an extra day. So bring on the slightly cooler air for the weekend. Let's hope so anyway. So without further ado, we are now going to break down a DCF model for the Mag 7. So we're going to be basically looking at revenue growth, margins, free cash flow, an intrinsic price, and an MOS, a margin of safety for each and every individual one. There's some surprising finding because obviously they have been leading the market for the past 10 years in terms of whatever movement they made, the market moved with it, mostly up, and some of them massively overvalued, or most of them were overvalued at this time. But there has been, the worm has slightly turned. We know that there's been a massive rotation into semiconductors, a little bit of self-doubt in terms of the capex expenditure by these companies, and they have gone fully fledged expenditure, fully rocketed to the space in some, pardon the pun, on SpaceX there, with their capex, and to such an extent that they've actually had to do some share sales on their own share price to actually get some more cash, Google amongst them recently. So clearly there is a shift, but we are going to be looking at the DCF model, which is one of my favorite models to that. We're not going to go through an analysis about the company backgrounds. We know what these companies do. Tesla, Google, Meta, Amazon, NVIDIA, Microsoft, Apple is well documented. This is a straight up valuation based on intrinsic price and free cash flow, and see if we can pin a good margin of safety, and is it basically full valuation, or do we want to hold, avoid, as the title says, or buy? So before we start with the actual evaluation of each individual Mag 7, I just want to quickly explain what is a DCF model for some of you that may not know, have just started this system, or maybe just coming in as retail investors. So, I tailor-made this show to pretty much beginners, mid and experienced people of all sides, but it is important to kind of explain what a DCF model in a very simplistic way, black and white way. So let's just go straight through that. Think of a DCF model as a financial time machine. It calculates what the company's worth today based on how much it will cash expected to make over the next 10 years. So based on this core idea, we project company cash profit for the next decade, because dollar today is worth more than $1 10 years from now. So we discount or shrink those future dollars to find out what they're worth in today's money. So it's almost like a time machine. But this is based on free cash flow, which is the lifeblood of the company. It can't be fidgeted by counts like the net income can be. This is what's left. This is what the company has in its lifeblood. So this is why we base this on the free cash flow basis. So we then, based on that core idea, we work out the intrinsic price. So the most important part, the intrinsic price, is a true mathematical value of a stock based on its cash flow, completely ignoring the hype and emotion of the stock markets. So all that noise that you see, all the stocks are over evaluated by emotions, gossip, and so forth, and news, of course. So this is stripping everything back down and right down to what we're basing, which is the free cash flow and the future free cash flow of the company. It tells you what the stock should be worth, not what the Wall Street is currently selling to you, which one investor calls it Mr. Market. So once you've worked out the intrinsic price based on the true mathematical value of the cash flow based on growth for the next 10 years, you work out a margin of safety, an MOS. So you minus that margin of safety off the intrinsic price. So because predicting the next 10 years involves guessing, let's be honest, it's not, you have to work out what the business may well be in the next 10 years. You never want to pay the full price. So the margin of safety is built in discount, usually 20 to 30%, which is for me, 25%. You apply to the intrinsic price to protect yourself from being wrong. So you don't buy the actual intrinsic price, you buy a discount of that. So for example, if a model says the stock intrinsic price is $100 and you apply a 30% margin of safety, it means you won't buy it unless the market price drops to 70. This ensures you buy cheap and minimize your risk. So that's the basic idea of the 10-year or 5-year, depending on what you guys want to look at. For me, 10 years gives it a bigger picture, especially if you are a mid to long-term value investor. So I hope that kind of makes clear. If there's any further questions, leave some comments below, and obviously I will answer back. But that is probably the most simplistic way to explain to you guys what we're about to do with the DCF model and actually calculating what the share price will be, the correct share price will be of the Mag 7. To Tesla. So Tesla, we know it has its up and down. So basically, straight to the point, I predict that Tesla will have a growth rate of around 30%. Now, that does seem quite high, but to be fair, it has been on average, you know, about to 18 to 13%. So for me, 30% is still quite a high amount, but I do believe that that gives us an idea of what the company should be making within the next 10 years. Now, obviously, there's a discount rate, which obviously discounts the money for the next 10 years. Obviously, as we know, the dollar does grow, and obviously we need to shrink it down to today. So that 8% is probably an average number that we normally tend to choose on all of my DCF models. Perpetual, which is beyond the 10 years, obviously, because no company is going to stop existing with it on 10 years. So you have to factor in that will be at GDP rate, or US GDP rate, which is between 2.5% and 3%. So based on that, with that growth, and then you calculate the sum of the free cash flow, the cash and equivalents, the total debt, equity value, and shares outstanding, it gives us an intrinsic value of $252 currently. So currently on the share price that we have, obviously, it is well overvalued at this moment in time. I'm going to show you how much by. As you can see from even the DCF revenue there, 56% above the 30% means that it's normally tends to be revenue. The revenue DCF, the reverse DCF, which is a spelling mistake there, apologies, is basically what is factored in by the markets as it stands. So if you compare that to the future growth, and it's above future growth, that means the stock is probably overvalued. So here we go. So the margin of safety is currently at 50% of premium. So that is well overvalued. Current price at 381. I think that obviously that moves about depending on the share price, but we're looking at that price. So right now, I would say that that stock is completely not only overvalued and is a possibly avoid at this moment in time. It's huge amount of premium. If you buy now, and if the stock collapses, then you will get seriously hurt on your portfolio, and that will add to potentially more hurt. So for me, that is definitely an avoid. So as promised, guys, the chart on the back end of Tesla. Now, if you do decide to buy, and I would strongly advise at this moment in time, based on the DCF model, that's probably not the right price. But if we were to have an entry point, you can see at the moment it's at 371, so it is pulling back at the moment, like most of the Mag 7 in the last week. I mean, I think if we're looking at potentially 337 as a support line here, I would suggest that's probably not a bad price to start, but even then the premium price would still be at an absolute premium. If anything, on my watch list, I would probably be looking at even anything between about 150 to 200 in that area here, where I think the discount might then be worth to look at. But like I said, it's so overvalued right now, Tesla, that for me it would be very hard to even look at potentially an entry point at this moment in time. But if you were really to be safe, I would even suggest 140 to 150 would be the ideal entry point. But again, we would have to relook at the DCF model at that stage there. But that's so moving on to Apple now, guys. Obviously, good old Apple, almost like a defensive stock these days amongst the Mag 7, pretty steady. Although it has had a major drop yesterday of about 5-6% due to increase in prices on their MacBooks, etc. And of course, some of you, I'm sure, will already know this due to the memory storage, which is costing them quite a bit of money. There seems to be a lot of finger pointing between Micron and Apple on this one, especially after Micron's good results. But that aside, let's have a look at Apple. Now, Apple for me, based on you can see a 5-year or the last 10 years, 7% and 2%. I've increased that because I think Apple will probably go and look at 10%. I think that would be a fairly low rate out of the options you may have here. Some of you may even believe that 20% is potentially more in the ballpark. But for me, let's go for the lowest end of it at 10%, based obviously on discount rate, perpetual rate, and the rest we all know, some of the FCF and the total debt, etc., etc., which gives us a intrinsic value, even of 238. Again, Apple is overvalued based on that. So based on this, guys, the margin of safety is at plus 23.8%. So that is obviously a premium at the moment. Again, a bit like Tesla, not as high as Tesla, but it is up there currently at the moment. We can have a quick look at the share price to give us an idea of where it's at, because obviously the share price that I put in there has obviously moved since yesterday. I think it's now 275, but you're still looking at a 20, 21, 22% premium on that. Which is quite surprising considering that Apple is quite a steady compounder these days. But for me, that is, again, still quite high. Wall Street are giving it a 315 at the moment, which is an upside of about 7%. But again, not that much more room for maneuver there in terms of the share price. So let's have a look at the Apple chart. It's based on a 1 week chart, which I like. It gives us an overvalue, as you can see there from the RSI and the MACD. I normally tend to put a Stoich there as a momentum more, but it's definitely on the wane. It's still well above its 50 and 200 moving average, so pretty comfortable in area, but there's definitely a retracement back there. Now, where would I buy Apple at this stage? Well, if it's at 23% discount, we're premium at the moment, not discount. You know, I think probably where it sits at the moment on the 200 moving average, around the 177, might well be a better entry point. I would even suggest that at the moment, to really make it a complete discount on margin of safety, you're probably looking at anything between 120 and 130, which is way down on where it is at the moment. Now, whether or not it ever goes back to that price, some companies like Apple may well never go any further than maybe 10, 15, 20% MOS. But for me, as a margin of safety, I think Apple is probably one of the safest one at the Mac 7 in terms of established. But obviously with the latest issues in terms of memory and the pricing being slightly obviously increased, or not slightly, some of them quite expensive, you do wonder if Apple can sustain this in terms of pricing with the rest of us buying those Mac Pros, which are absolutely outstandingly expensive. So for me at the moment, Apple would also be an avoid in terms of DCF, MOS, and also even entry point on the chart. But as you can see, it again at an all-time high, you know, only recently. So for me, it's an avoid. Moving on to Google. Now, the number one of the Mac 7 as we speak. It has come back from the dead, really, about 2 years ago when, obviously, the arrival of OpenAI, GPT thought that it would destroy Google's search engine, and it certainly hasn't, and it's now bounced back bigger and ever than before. Now, in terms of the DCF model on this, again, you will see that it is massively overvalued. Now, I put a fairly conservative 16% growth rate, which, you know, really, to be fair, it should probably easily target. And again, as you can see from the reverse DCF at 19.30, so it shows you that the expectation is already quite high, which means the stock is overvalued. Even if you were to bring it down to 14%, you're looking at anything between 264, which is a minus 24%. So if you calculate everything as we did from the last two, it comes to an intrinsic price roughly of around $305 a share, currently at $346. So again, massively overvalued. I would say massively overvalued is probably an understatement. Let's have a quick look at what the MOS is on Google now. So as you will see from the actual MOS there, just to kind of take the MOS apart from the intrinsic price so it's clear, we're looking at around 13% of premium. So when I mean premium, is overvalued, not undervalued. So at the moment, yet again, like the other two, Tesla and Apple, but again, slightly less than Apple and Tesla, it is overvalued by quite a bit. Now, Wall Street does give it a forecast of 433, so it does give it an upside of 25%, but that's just based purely on the share price. But for me, the DCF model at 305 versus 345 is clearly overvalued. So let's have a quick look at their chart. So looking at the chart now on Alphabet, it currently is at 341. It has also taken a retracement back, but they all have recently in the last few days. But you can see there from my chart, we've got the MACD, which is the momentum, and the obviously RSI and the ADX. But for me, again, looking at the one-day chart, you're really looking, if you're buying now, you're really looking at a premium, even if you were to buy at 250, 260. Off the 200-day moving average, we're looking at 138, which is possibly more in the ballpark. So again, very hard to tell where to buy. But obviously for me, it's an avoid as well on Google. Even so, it's probably the best company in the world. Yes, big investors have bought into it, and potentially there's more to go. But if you're basing this on an intrinsic price versus an MOS, a margin of safety, if you buy now, you are buying at a massive premium of the share price and what the market is telling you. So for me, it's even so, like I said, lots of big investors have bought into it and believe that it will go up further up. For me, it's a no based on that at the moment. Yeah, it could easily hit $400 a share. It could probably go up to 450, 500 based on the fact that it is an amazing company with great fundamentals. There's no second guessing there. So I suppose in a way it's a little bit like what will come to an Amazon, where you have such established companies that are so much part of the fabric of our society. Moving on to Meta, guys. Now, the first one to potentially be undervalued out of the last three we've just seen. Meta has gone through a bit of a rough patch recently, and we'll see through the charts in a minute. So my growth rate, which I've given to Meta, is around 12%. I think that's actually very conservative, considering that it was 16% for the last 10 years, pretty much. And I think it's kind of in that middle rate growth, which sits quite well for me in terms of growth rate. The reverse DCF is actually factoring at 5.70 percent. So you can see that for the first time since we've started this DCF model of the Max 7, it comes under the growth rate that I have chosen for this stock. Now, it gives us an intrinsic price once you've mixed matched it with a discount rate, perpetual rate, and the rest here, total debt, equity, value, shares outstanding, etc., etc. It gives us an $823 keep making that mistake, dollars intrinsic price. So that's quite a bit above the current 545, although it said 562 there, but it has fallen back since then. So let's have a quick look at the MOS. Here it gives us a 31% discount, not premium, discount. This is the first one out of the first that we've seen on the Max 7, which is undervalued, and by quite a bit because of the recent fallout. 31% is an outstanding amount, really. It's well above my criteria of the minimum of 25. Wall Street even gives it a $927 upside, which is a 54% upside. So that's quite a substantial amount. So let's swiftly go on to the charts. So as you will see there, it's currently at 544. Yes, guys, it is a phenomenal fall. It has obviously peaked at 730, so it's way off its highs, and it's currently at 544 and on its way down. I would even suggest that potentially it could fall back as far back as the 500, even maybe just above that 200-day moving average. It is potentially a catching knife at a falling knife, even not a catching knife. Sorry, apologies for the wrong wording there. It has been a hot week, and at the moment on the weekly chart, it's certainly in terms of Stoich and Max Stoich was obviously the momentum of the stock, which I prefer to the RSI, and the MACD is currently in selling mode. It really is. And if we actually switch it to the one-day chart as well, you will see that it is well oversold at the moment and not coming out above the water. So I think there's potentially a further fall. Now, I would suggest that maybe a target or an entry point of around anything between 500 and 520 would be probably the safer bet, which will probably give you a 35 to 40% discount by the time it settles at the moment. Now, there's always a chance of a bounce, of course. But for me, Meta at that valuation is incredibly attractive. There's no doubt about it that it is a phenomenal company that's come back again from the dead back in 22, a bit like Google story. It's come back stronger than ever, and it will obviously, with its AI ad and its fundamentals, it's going forward. And I think Meta is potentially the same issue as everybody else. The CapEx expenditure is having an issue, amongst obviously a few court issues as well, injunctions going on. But all in all, really, I really find it amazing that Meta is at that price and probably going to be even cheaper. So if I was you guys, I would probably put this on the watch list and look at potentially wait for it to kind of settle down to its bottom rate, which I think would be potentially, and it's hard to tell, 520, 500 to 520. We know it's a big company. Again on the retreat, very similar story to Meta at the moment, being punished for its AI expenditure, CapEx at the moment, amongst a few issues in terms of software and being a software company. It's got caught into a bit of the SaaS situation. We know the story about this, so we don't need to go, sorry for too much further. I'm giving it a 14% growth. Now, there's a little mistake here. The 10-year KGI is 13%, so I've given it a percentage growth. I think it's quite reasonable. A mid-range there, I think between 12 and 16%. You could go as aggressive as 16. And I think in terms of the intrinsic price, it gives it about a 479, pretty much 480 if you want to call it that. So again, very much it seems undervalued. So let's have a quick look at the MOS. So the MOS at the moment is at so the intrinsic price, is 479, and the MOS, the margin of safety, is currently at 22% undervalued. And actually, it has gone down since, so I think it's probably almost at 24%. Now, are you ever going to get a company like Microsoft at 24-25% discount? Well, not in the last 10 years you won't. So this could be an opportunity. The fundamentals are still massively strong. I think the company with Azure will eventually, blow up once they've got the infrastructure expenditure completed. I think it will even get bigger. And I think that the return will be massive in terms of numbers. They're just going through a bit of a funny patch at the moment and a software situation, but we know that Microsoft will still be around. It's part of the fabric of any businesses, of course, with Microsoft 365 and all the Microsoft Office, of course, and it is at the moment at the cheapest it's ever been. Now, Wall Street's even giving it a 561, which is a 50% upside. That's obviously based purely on the share price. So for me, Microsoft is a buy all day long. I've already bought in and I may well buy even more. Let's have a look at their chart. As you can see, Microsoft chart here is currently at 355. Who would have thought that you could get a Microsoft under its 200-day moving average, by the way, which is rarely seen in the past couple of years. As you can see there, it's been well above it. But for the first time in many, many years, it is under and has broken through, which is probably a reversal. So, as you can see, it's not looking pretty. The Stoich is very much down and out into the oversold. So is the MACD now on the 1 week chart. On the 1 day chart, it is absolutely buried in oversold at the moment and not looking like to go up. So there is still probably some way to go before Microsoft eventually settles to possibly a reversal back up to its, share price. So we know that the last time it was as low as this, we're looking at 2024, around that mark. Maybe even before that, actually, looking roughly here at the chart. But maybe the next move down from where it's at the moment could be as far down as 320, even potentially to 300. So I would be you guys. Again, I would put it on the watch list. I bought quite in early. You could buy now because you're already getting a 22% margin of safety. If you wait a little bit longer, you may well even get at this stage really even better margin of safety at 25%. So for me, if you're a new entry, you want to buy a little bit, maybe buy a little bit now, 25% of your account, and then maybe add more as it falls back, or wait a little bit longer and maybe wait for the 320, 330 mark, which will give you a potential 24 to 25 margin of safety, which I think would be probably even safer than what I just did. Second from last of the Mag 7 guys, we're getting there. It's NVIDIA, the humongous leader of all companies for the past 2 or 3 years at least. It has turned a market on its head by just waiting for its trading update. It is a magnificent company that's come from pretty much nowhere 20 years ago, or supplying computer graphics, which I bought many of times. and now becoming the leader of the AI revolution. And it is still a magnificent company, but there is a massive surprise, and probably the biggest surprise of the 7. It is undervalued. Yes, guys, NVIDIA is currently undervalued. I would never have thought it until I looked at those numbers. Obviously, based on my own growth rate, it is down to you whether or not you feel it's under. So if it's under that, maybe slightly less undervalued than it should be. But I believe that considering that the 5-year CAGR and 10-year CAGR between 59 to 86% growth, I think putting it back to only 15%, which is super conservative, if you ask me, you're still getting an intrinsic price or value of $262. Can't let the share price, we'll have to look where the share price is. But even with a reverse DCF of 10.40%, it still is undervalued. It is under what we are looking at, and that's been conservative. You could almost push it if you wanted, guys, to 20%. I wouldn't be adverse to that either. But for me, again, I'd like to always look at, the silver lining of everything. And I think 15% based on a company that's now very much established. And as you grow up, obviously your earnings will be massive or bigger. And as you establish yourself, you become, obviously, you maybe lower the expectations of the growth. There's only so much growth the company can have on the way up. Once it gets there, then I think 15% is probably about right. So let's have a look at what the MOS is on NVIDIA. So the intrinsic price for NVIDIA is currently at 262. And the current price is at 193. It's actually fallen through since I've done the graphics for this. So we're looking at almost 24% discount on NVIDIA. Now, it's just short of my criteria of 25, but my God, we could be looking at a slight notch down, and you could be looking at the criteria of 25%. Who would have thought that NVIDIA is underpriced at the moment based on intrinsic price, the DCF model? So that is quite a surprise. Probably the biggest surprise of the 7 for me so far. So definitely interesting there. So let's have a quick look at their chart. So looking at the chart now, we're looking at a share price of 193. Let's go to the weekly chart. And as you can see, it is on the way down. There's definitely a correction going on at the moment on all Mag 7s. And it is just above a 50-day moving average. Still well above its 200-day moving average. But it is fallen for the first time into a selling mode on the MACD. There's a crossover there, which you can see. And also not oversold. I wouldn't say it's been sold off yet. But it has fallen under 50%. So which means there will be a slow in growth. So for me, definitely again on the watch list, I would probably suggest that because of my criteria of 25% or 24%, yeah, possibly a small increment of buying now, or you guys could wait and see if it falls just above that 50-day moving average. Maybe 175 would be a great price. That would then trigger my intrinsic price, my margin of safety, of 25%. So definitely, I think, a potential buy or watch list at the moment. Very similar, I think, to Microsoft and Meta, who for me at the moment, all three of them are potential buys. So onwards and forwards to the last of the Mag 7, the mighty Amazon. Amazon is everywhere, absolutely everywhere. I can't do without Amazon myself in terms of buying. I know that my girlfriend is the same. Everything is bought through Amazon. It is absolutely within the fabric of society again, and will be around for forever, I think, pretty much. And you can see by also the amount of big investors that have bought in recently, where they're buying in at a fast rate. So it is interesting to find out that actually, based on my intrinsic price of what it is at the moment, we are looking at pretty much $303 intrinsic price. It's currently at 227. So as you can see, actually, the graphic slightly changed there. It gives us a margin of safety of 22%. Now, I am basing this on a pretty much roughly a 12% growth rate with a reverse DCF of 3.8, which I think is factored in by the markets at the moment. So immediately you can see that the price is definitely, you know, undervalued as it stands if you obviously go through this DCF model over the next 10 years. Again, a bit of a surprise because I would probably buy. I'll give you an idea of where I would buy on the price that I would buy Amazon at. But it seems to be undervalued, and it's again another surprise to me. I haven't looked at a lot of these companies for a while, so it's actually good to refresh ourselves of what those companies may be able to be worth. But like I said, there's a definite turn of rotation on a lot of people going for semiconductors and this AI fever at the moment, and it seems that the new guard is now becoming the rear guard, the old rear guard, in terms of the value of the share prices. And actually that's what makes it quite interesting. That's why I decided to do an upload, because I've realized that actually probably more than 50% of the Mag 7 is now undervalued. So interesting points, which I will come to my final thoughts of the day. So let's have a quick look at the chart on Amazon. And as you can see here on the 1-day chart, it is falling through. Now let's have a quick look at the 1-week chart. And as you can see there, it is again, like all of them at the moment, retracing back off its high, or high highs even. And I would potentially look at, and I have bought it in the past, look at buying in. For me, would be definitely on the watch list, and I would be looking at $200 a share, which would give you even more value of margin of safety, which would be above my criteria of 25%. So definitely on the watch list on this one. I think there's a good potential that it may well even reach maybe around the 215, 210 mark, which again would be interesting in buying as we start. Now, the big question we've all got ourselves is whether or not this is a proper reversal, a proper pullback on the Mag 7 for a period of time. So you've got to be careful that you buy at the right time, hence why I'm trying to give you an idea of the entry points. But for me, again, surprise, as I said, Amazon is pretty much, we know, going to be around for the next 100 years. I'm pretty sure of it. We'll probably be expanding even more in different areas, and I think Amazon is definitely very attractive in terms of investment. You know, you can't really go much wrong unless something, well, dramatically goes wrong. But I think at this stage of play, I think a buy around the 200 mark would be my safety zone. So I will put Amazon again on the watch list. So my final thoughts, guys, in terms of the Mag 7. Now, just to recap, there's all these businesses are elite. None of them are going to disappear in the next 5-10 years. They're well established. Every single one of them has an incredible fundamentals, massive revenues, fortress balance, huge moat, operating margins, and most importantly, in very strong free cash flow. Although, on the other side of that, free cash flow is being spent quite dramatically, which it hasn't in the past. It was obviously building that cash flow. So from the bull case, definitely all quality stocks at the moment, and there's no doubt about it in terms of each individual companies. As you can see there, you know, Meta dominates the digital advertising, Amazon dominates e-commerce, NVIDIA is the AI kingmaker, Tesla, well, autonomy, robotics, taxis, we'll see about that. I think that may be the in my opinion, it's only my opinion, the weakest one out of the 7. And Microsoft dominates the enterprise clouds, and Amazon, obviously, and everything else. So I've already repeated myself there on that side of it. Now, the weakness in terms of what's going on and why there is a rotation out of, clearly a rotation out of the stocks, is AI capex expenditure. I think people are starting to get a little bit doubtful whether all this expenditure is going to be turned around into money, profit, bottom line, monetizing what they're spending at the moment. Microsoft, all of them are spending billions on AI infrastructure, data centers, GPUs, custom chips, networking and power, combined with a projected expenditure of almost $700 billion. It is outstanding, and probably more going to the future. Now, Wall Street is asking the question, I'm asking the question, are we actually going to see a return? I believe that we will be. I think these companies will be even better off and will be double their revenue stream by moving with times and not being left behind and having to spend that money. So in my opinion is that this will pay off. Now, I'm not a financial advisor, but I can't believe that these companies at this moment would spend that kind of money, the rest of their reserve, to just fall behind and not work out. Now, obviously, there's always an element of failure. We know that. Some of them may well fail. Some of them may come out really well out of it. There might be just 1 or 2 winners out of the 7. Who is to know? But for me, at the moment, that is definitely, I think, a good play by all of them. And they will be stronger going forward. Now, there is also a rotation out of towards SML, Micron, Broadcom, Marvel, as I've actually done a few YouTubes. Please do check them out in my playlists, somewhere around here, as I keep going on there. So I think definitely at the moment they're being left behind because they're no longer fashionable, potentially, to combine it. So, is this an opportunity? It is indeed, guys. I feel that it has a long-term opportunity as a value play. I think that on my list at the moment, I would be looking at, definitely out of the 7, I would be looking definitely at Meta, Microsoft, NVIDIA, and potentially Amazon. I think Apple, Google, and Tesla, all amazing companies, are overvalued, so I'll probably stay away from that at the moment until they do come down themselves. If I had to pick 1 or 2, I would probably go for Microsoft and Meta at the moment because they are super cheap in terms of margin of safety. So that's my opinion only. Let me know what you guys think. Always happy to see what you guys are thinking. I think this is a very important potential opportunity. And like I said, any questions below, please leave comments, even at if you disagree or agree with me, if you think that my entry points or whatever you may think about entry points won't be the best to come up with. So just to recap, guys, I would definitely put Microsoft and Meta in my top buy list. Watch list, I would probably put potentially I think Amazon, NVIDIA on my watch list at this moment, and I would probably avoid for now Tesla and Apple and Google being massively still overvalued. They're still not come down to the price that I think are worth maybe a look at. So that's my take on all 7, and I will probably buy more on Microsoft. So let me know what you think below. Any comments on what you think? I'm looking forward to your feedback on that, and that closes the Mag 7. So just very quickly, markets are looking a little bit in the red. I think again the interest rate hike is having an effect on the companies. A lot of obviously the rotation out of the Mag 7 is having an effect as well. It looks like there might be a bit of a profit taking as well on the chip makers after Micron's amazing results yesterday. So we are in the red. Also a little bit of tension in the Middle East, blah blah blah. That's always the same story, but still the oil is still pretty much at $74 a barrel. I've bought and sold into Uber this week, made a tidy profit. Bought into Microsoft quickly yesterday as well, so we know the last few weeks, so that's still on. And I've just bought a new position which probably cashes me out at the moment. I can't really buy any more until I sell something, which is S&P Global, which I bought at 406 yesterday. I think it's a terrific company. I got it on the retreat. And while it's oversold, I thought it would be a good time to buy in. Again, fundamentals, fantastic compounder, is one of has pretty much the king of the moat with Moody, and is about to spin off one of their automotive companies off that. So I think there's great potential with S&P Global. I got it under $400 a share. It's at 24% discount off its intrinsic price. So I bought in. And about 2,800 shares already in the red as we speak, because I may have bought slightly too early, but then beauty of hindsight. So there we go, guys. That's the latest news. I'm probably going to stick with this for over the weekend. As I said, I like to kind of buy in and out quickly, but sometimes I'm still holding Adobe, Microsoft, and Netflix, which is causing me untold amount of trouble at the moment. Microsoft is going through, Netflix is going through a terrible time at the moment. Whether or not I halve my position is something that I made to free up some cash to buy more into maybe potentially Microsoft or S&P Global. That is a decision I will make over the weekend. But there we go. That is it, guys. I hope you enjoyed. Let me know any comments, subscribe and like. And from one retail investor to another, this is Trader72. Over and out. Have a great weekend. Let's hope it cools off a little bit and get ready again for next week. Take care.